Today I'm going to go through an activity on analysis and interpretation. If you have a look at the question, here you are told that the information appeared in the books of Stylish Limited, and quite important here, they tell you what the business sells, which is high fashion men's clothing for a young executive. Then they give you a whole lot of financial indicators here. When they do that, rather start straight with the questions, and then you can refer back to here as you go through. Just before I start doing the questions, I'm not sure if you've heard of the saying, mind your P's and Q's, basically meaning remember your pleases and thank yous. In terms of analysis, your P's and Q's, I want you to remember the P stands for answers in point form, and the Q stands for quote. If you do not quote figures, you will not get all the marks that are available for the question. Right, the first question asks you if stock turnover rate tells you stock turnover rate has decreased and whether you think it's reasonable for this type of business. Remember, stock turnover rate is the number of times stock is bought and replaced during the year. And it has decreased from 4 times a year to 2.3 times a year. But because you're selling men's clothing, you basically have 2 seasons for men's clothes, summer and winter. So therefore, the stock turnover rate is still reasonable for this type of business. And then 2 disadvantages of the decrease in stock turnover rate. If stock turnover rate decreases, it means you've sold less. And if you've sold less, you may be struggling to move your stock, and therefore stock could become out of fashion. And because you're selling less, that will also lead to a decrease in your profits. Then, as a marketing director of the company, explain 3 strategies which you wish to implement to increase the stock turnover rate. In other words, to sell more stock. Okay, you could increase advertising. If you increase advertising, more people will become aware of your product that you're selling. You could have markdown sales, sell stock for a lower price. That can also attract customers. And then another thing you could do is you could do proper research to determine what your customer demand is. And then when you're buying stock, purchase stock that is in demand by your customers. Right, question 2. The business has relied more on borrowed capital to finance operations. Quote figures from the information that would substantiate the above statement. The relevant financial indicator here is your debt-equity ratio. Your debt-equity ratio shows how much debt compared to how much owner's equity. So last year it was 0.4:1, this year is 0.8:1. In other words, your borrowed capital here has increased. So that is what you are showing here when you say your debt-equity ratio has increased from 0.4:1 to 0.8:1. Do you think it was a wise decision to borrow capital? Give 2 reasons for your answer. Whenever you're asked whether it's a good thing to borrow money, you must always look at 2 things. You must look at your debt-equity ratio for your risk, as well as your return on capital employed to see whether you're using the money effectively or not. So first of all, you are now a high-risk business, because for every 1 rand owned capital, you've borrowed 80 cents. And then the second thing here is your return on your capital employed is below the interest rate on loans. That means you're paying somebody 18% interest and you're only generating a 14.7% return. That is known as negative gearing, where your returns are below your interest rates on loans. Right, then the business changed its dividend policy. Explain how it's changed. When you ask about the change in dividend policy, you need to work out how much of your earnings are being paid to your shareholders. In other words, you're going to look at your earnings per share here and then see how much of that is getting paid out to shareholders. Now you can see in 2024, the company is paying out a much higher percentage than in 2025. And quote those figures. So I wrote here that they paid out 35 cents out of 54 cents rather, which is around about 65%. And then in the current year, they only paid out 12 cents out of 69 cents, about 17%. That means the company is retaining income. They are paying out less dividends to the shareholders and keeping more money for themselves. Then list 2 possible reasons for the change in dividend policy. With this business here, the business has become less profitable, so your return has decreased from 11.4% to 3.6%. So if the company is less profitable, they won't be able to pay out as many dividends. And also maybe they wanted to expand, and therefore they retained more income. As they retain income, shareholders' equity increases. In other words, shareholders' equity, which is share capital plus retained income. If retained income goes up, shareholders' equity goes up. And remember, assets minus liabilities equals shareholders' equity. So if shareholders' equity is increasing, then either means assets have increased or liabilities have decreased. And in this case, liabilities haven't decreased, so the business must have purchased more assets. Right, then the return for the shareholders is unsatisfactory. 2 reasons to support this answer. We look at the return on shareholders' equity here. So your return on shareholders' equity has gone from 11.4% down to 3.6%. So that's the first thing that you're going to be dissatisfied with. And then if you compare this to the interest rate on fixed deposits, you could get more money if you left your money in the bank and risk-free. You'll get a better return than investing in this company. So your 2 reasons then is your return on shareholders' equity has decreased and your return on shareholders' equity is below the interest rate on your fixed deposit. List 2 ways in which a higher return could be earned from the shareholders. To do that, you basically need to make more profit. So you could sell more stock or you could decrease your expenses. The shares in the company are trading at 340 cents per share on the JSE. Is this a realistic value for the shares? When you are asked this, you need to compare to net asset value per share. Net asset value per share is the real value of the share. So the real value of this share is 300 cents here. And yet they are trading on the JSE for 340 cents. So therefore, shares are actually overvalued on the JSE because shares are being sold for more than they're actually worth. And then as a shareholder, would you be prepared to sell your shares at the current market value? Yes, you would. 2 reasons. You would sell your shares for more than they're actually worth. And secondly, it looks like the company's results are deteriorating as well. So it might be a good idea to get out while you can. Then the period of credit has granted by creditors has increased to 90 days, whilst debtors settle their accounts within 60 days. Explain why this will benefit the company. 2 points in your answer. If debtors pay before creditors have to be paid, you can use the money received from debtors to repay those creditors. And then the second reason, because of that, you won't need as much working capital because you will get money from debtors before you're required to pay your creditors. Do you think 60 days is reasonable to give debtors to settle their accounts? Remember, you're selling high fashion clothing, which tends to be expensive, so give customers a couple of months to settle their accounts. So in my opinion, it's reasonable. Please remember one thing here when you're doing analysis. You can actually disagree with the answer here, and you can say no, debtors should be able to pay their accounts within 30 days because they should be able to afford to pay for the clothing that they are purchasing, something along those lines. You will get full marks for that. Just remember to back up what you are actually saying. And then briefly explain 2 ways of encouraging debtors to settle their accounts in a shorter period. There are several things here. You can charge interest on overdue accounts. You could offer settlement discount for prompt payment. You could send out reminders, etc. Right, that's it for this one, and then in the next video I will do 2 further questions on analysis.